Well, hello. My name is Michael Blanc, and today's topic for passive investing is what happens when we exit an investment. If you're wondering about that, what happens when you exit an investment, passive investor, then stay tuned and help me unpack this topic is our investor relations director, Bronson Hill. Bronson, what's going on today?
Howdy, Michael, and good morning, good afternoon to everybody watching, all of our passive investors. A question that comes up, Michael, that we're going to talk about, as you mentioned, is what happens when we exit a deal. So maybe you can talk through just what are some of the options or what are some of the things that you can do as a passive investor when you exit a deal?
Typically, when an investor hears exit, they're thinking sale, and that certainly is a sale. It's a type of what we call a liquidity event. Liquidity event meaning that you're getting part or all your capital back. But the other liquidity event / exit is when you do a cash out refinance. So those are the two main ways that we can exit an investment.
I see. Can you go into the first one to talk about a refinance, kind of what that looks like?
Yeah, so refinance is when we go in and let's say we're doing a value add deal and we buy it for a certain amount, we put a certain amount of renovation budget into that, and therefore we're increasing the income of that property, therefore also increasing the value of the property. And then down the road, 12, 24 months, 36 months, we can actually do a refinance at a higher valuation. And the loan proceeds from that higher valuation is used then to, of course, repay the old loan, but also return either part or all of the capital that investors invested. And so that is super exciting. Let me show you real quick what this looks like. So here's, for example, this is a deal that we did fairly recently called now the Davis, 275 units in Huntsville. And we bought it for $18 million. These are round numbers. These are not exact numbers. So it's $18 million. We're putting $4 million in because we want to improve the property and make it look pretty. All right. And so let's say you're a limited partner here and you're investing your $100,000. And our NOI at the time we purchased is about $1 million a year. Now, let's say we go in there and we are able to increase the NOI to $1.5 million after, say, 12 to 18 months by improving it and raising the rents. What happens is, we bought it at 18. We put in 4. We're into it for 22 million. The valuation based on this new NOI is now 25 million. Okay, so we've raised the value because we increased the rents and increased the income, therefore increasing the valuation. Okay, so now what we can do is we can then refinance, and what you'll see here is that when we refinance, we're returning 51% of the investor capital. So let's say if you invested $100,000, you get about $51,000 back, and you have $49,000 in the deal. Now, what happens is the cash on cash. When we did this before, our cash on cash was 1% when we got it. We increased it, and so the cash on cash now goes up to 6.3%. If we were to increase this a little bit more, let's say we're going to 1.6, you'll see it increases disproportionately. And you'll see the cash on cash get higher and higher as this increases. Because why? Because we're turning more and more of the investor's capital, and therefore less and less capital is in the deal, meaning that the return actually goes up. Because the return is measured by my cash distributions divided by how much money I have in the deal. And so that's really an example of one of the exits of the two.
That's great. So yeah, it sounds like with a refinance, it's always preferable as an investor because you get some of your money back early and you're able to also reinvest that money. It comes back as a return of capital, which is pretty great. Can you talk to us for a minute about a sale, what the couple options are when a property is sold, Michael?
Yeah, so I mean, the typical sale is you sell the asset and you make some money and you pay your taxes and you do whatever you want to do with it, and that's a straight sale. The other option, though, is to do what's called a tax deferred exchange, what's 1031 tax deferred exchange. And what you do there is you basically take the proceeds of the sale and you use it to buy another property that is equal to or greater in size. Now, the good news about that is if you set it up correctly, not all of the investors have to agree to do this. It could just be the majority of them. And what happens is that gain is then rolled into another property without paying capital gains. And that is a beautiful thing about real estate. You can do this with any real estate. You can do it with a house as long as it's like kind. And so that's a great strategy that we're going to explore as we start exiting some of these properties. Now, the ideal scenario in my mind is to do the refinance / hold strategy, right? Because a refinance is a non-taxable event. If we do a refinance and a loan and we distribute proceeds to the investors from the loan proceeds. That is not a taxable event, but you still get your money back, which is really cool. And so now we can hold on to the property. Let's say we can return 80% of the investor's capital back. The risk is off the table. The investor now doesn't really care too much if we're going to hold for another 10 years because they're still going to get cash flow distributions on that. And so a non-taxable event, and they're still getting distributions on it, and it's a wonderful thing. So that's, in my mind, a win-win for everybody.
Yeah, that is really a win. So Michael, can you talk about when there is a sale or when somebody does get their money back? There's this thing called reinvestment risk. Can you talk about what that means?
Yeah, so the reinvestment risk is that in this environment, valuations are sky high, and of course it's a great time to sell, which is good. You make a bunch of money, which is great. The downside of that is, okay, now you sell this property, what are you going to get into it now, right? The investment risk is there are a limited number of opportunities available. So yes, you make a bunch of money, but now you have a less likelihood of identifying a new opportunity to put this in. I mean, we talked to passive investors recently. They sold something for a large capital gain and wanted to roll it over into triple net property, which is great, but the returns are so low they can't really find a suitable object. So that's one example of reinvestment risk that we have as well. The other one, of course, is you don't really know, what the future will hold. Should I sell now? Should I stay in it? What are the cap rates going to be? What are the interests? So the uncertainty, in a sense, is a reinvestment risk. At the end of the day, you want to make sure your money is working. And that's one thing. The downside of the multifamily syndications is that your money is tied up or it's illiquid. But the upside of that same thing, it's constantly working. It's constantly being compounded. And so you want to make sure that you want to have your money reinvested at all times.
Absolutely. And what would you say, are there some other considerations that people should consider when selling a property, or a property is being sold, I should say?
Yeah, I mean, tax considerations, obviously, as we talked about, are pretty big. If you're investing with your IRA, which is a great thing to do, be aware that you can actually be taxed in your IRA. This is something called a UBIT, unrelated business income tax, and it really is for investments in your IRA that are leveraged, that have debt with them. Of course, real estate has debt or a mortgage with that. Therefore, you will actually be taxed in your IRA. You probably didn't know that. We actually have a couple of blog post videos about investing with your IRA, and the solution to that is to basically create this thing called the EQRP, or QRP, a qualified retirement plan. And you can transfer your traditional Roth or a traditional IRA or your Roth into this QRP plan, and it avoids this UBIT tax, and it's fantastic. To find out more about this, you can go to themichaelblank.com/QRP. It's actually a partner of ours, Total Financial Control, that puts these in place, and we're advising all of our investors, especially as we near the end or the exit of a deal, to transfer all their IRA to this QRP to avoid this UBIT tax. Because not only does it cost money, it's a giant pain in the butt, and the paperwork related to filing taxes in your IRA are just staggering. So our partner, Damian Lupo, actually has a book you can request for free on this. It's themichaelblank.com/QRP. Or if you're ready to do it, just schedule a call with him. I've been through it myself. It's a really painless process of transferring your IRA over. So those are some considerations as you're considering exits.
Awesome. Yeah, I have a QRP. It's a great option. I think every investor that's in a syndication before they exit should definitely look hard at that. Michael, can you talk for a minute about the passive income calculator?
Yeah, so we have this free download for passive investors who are trying to do some planning. And when you're with your financial advisor, they'll give you a sheet for until you're 89, 90 years old, of how much money you're going to make if they invest with you. And so I try to do something similar where you can do some projections. And so it's pretty cool because it's this sheet right here. And back to the power of refinance, for example. Here's a screenshot of the sheet right now. But if you're investing, let's say $50,000 per year, and you refinance your properties after 2 years, and you get 50% of your returns back, you can see what happens to your cash on cash return in about 5-6 years. It shoots up from your 7 to 8 to 9%, which is really darn good, to 20%, 24, 25%, because you're getting part of your capital back, and you're now able to reinvest it in a new deal. And that's really exciting. So I'll put the spreadsheet together. If you want to have some fun planning out your passive investments, it'll answer the question, hey, how much money do I need to invest over how many years until I get this much net worth or this much cash flow out of it? So that's going to be at themichaelblank.com/PIC for passive investor calculator. So themichaelblank.com/PIC, and you can download this calculator.
Awesome, Michael. Well, thanks for sharing with our audience and all of us just about how to, kind of navigate some of these waters. I just want to speak directly to each of you watching. If you are interested in being involved in some of the deals that we do, we're constantly doing deals. We're looking at deals. We're finding deals. We have our Nighthawk Investment Club. And so if you'd be interested in joining and being a part of future deals with us, go to nighthawkequity.com and click the join button, and we'll set up a call with you and be able to get you on our upcoming investment list. So thanks again for taking the time to educate yourself, and we'll look forward to seeing you on the next video.
Hey, and before you go, make sure you subscribe to my YouTube channel because we're putting stuff out every single week. Also, check out this special report just for you. It's what's the best investment, the stock market or real estate? It's going to blow your mind. And here's another video for you to check out.